Nigeria's inflation hit 28-year high at 31.7% for February. Also, Nigeria's functional oil drilling rigs rise to 16. And we'll also be looking at China, a country willing to work with Angola as the top oil producer in Africa moves on from oil. This is Business Edge. I am Lekon Obanjo. It's nice to have you around. Let's start with top business headlines from across the continent. The naira strengthened against the dollar, closing at 1,597 naira 24 kobo to a dollar in the official market and appreciated to 1,608 naira per dollar in the parallel market. The investors and exporters window showed mixed results with significant volatility observed. Despite this, the naira made gains against the pound sterling and euro. Forex dealings increased by 2.20% to $140.45 million. While Nigeria's foreign reserves saw a slight rise to $34.416 billion, marking a 0.008% increase. This upward trend in reserves has been consistent for around 3 weeks. Overall, Nigeria's forex market indicates some stability and positive movement, but challenges persist, particularly in managing volatility within the I&E window. The Economist Intelligence Unit has said that the Nigerian government is expected to increase value-added tax to 15% to fund deficits and service debts, including social and job creation projects. The international business research firm disclosed this in its country report for March 2024. The firm said the deficit could increase to 5% of gross domestic product in 2024, above its 2023 estimate. The ERU also said the projection is expected to be about an average of 4.5% of GDP between 2025 and 2028, above the legal limits of 3% of GDP, representing an unusual tax period for Nigeria. Finally, the World Bank Group has said it intends to provide more than $6 billion of support over the coming 3 years for Egypt, which has been struggling with a foreign currency crunch and gapping budgets, including balance of payments deficits. The World Bank Group said $3 billion will go towards government programs and $3 billion to the private sector, all subject to the group's board approval. The announcement follows Egypt's signing on March 6 of a loan agreement with the International Monetary Fund that expanded IMF support to Egypt by $5 billion and by an announcement on Sunday of $8.1 billion in financing from the European Union. And that's African Business Stories. When we return from this break, it will be time for market updates. The NGX All Share Index declined by 0.40% to close at 104,663.34 basis points compared to the previous day's gain of 0.99% to close at 105,085.25 basis points. The NGX market cap also recorded a loss of 238.55 billion naira. Year to date, the NGX ESI stands at 39.97%. Let's now quickly take a look at the numbers, beginning with the All Share Index. And there we see it, 104,663.34. Looking at the ASI with a deficit of 0.40%. And now to market capitalization. And there we see a threshold of about 59 trillion naira in market capitalization, just about minus 0.04%. We now look at the top 10, the top 5 price gainers for the day. Now, ABC Trans tops the chart, closing at 78 kobo, followed by NEM Insurance, 7 naira 30 kobo. Livestock also closed with 1 naira 70 kobo rather, and NGX Group 24 naira 10 kobo. And the last, Tomaswi with 1 naira 99 kobo, more or less like new entrants, topping the 5 Guinness chart for the day, and of course with a differential of a positive 9%. Let's look at the top 5 losers. We see MC Nichols, Darcom, UPDC, MTN Nigeria, and Regular Links closing at 1 naira 17 kobo, 71 kobo for Darcom, UPDC 1 naira 40 kobo, And the MTN Nigeria that has been struggling for a couple of weeks now, also making up the top 5 in the losers terrain with about 247 naira 50 kobo and regularly 0.3, that's 0 naira, or let's just say 37 kobo at that. Of course, we see the differentials there in the change, minus 9.30%. all the way down to minus 5.13%. Let's quickly look at the sectoral performance. We see banking, the banking industry that keeps topping the charts, also with a differential of plus 2.53%. Insurance, oil and gas, consumer goods with plus 2.95% and just about a percentage points there with the industrial goods with just about 0.03%. And that's it, looking at the market performance. Now we go on a short break to look at another area of the market that we also need to consider. Now, inflation woes deepen in Nigeria as the headline rate surges to a staggering 31.7%. Perpetual Fasomi Peter joined us earlier from Mile 12 Market to talk about how the latest inflation figure impacts the prices of commodities.
I saw 2 or 3 people live here. They ended up not buying what you're selling. Why is that?
Reason most of them, they cannot cope with the price because what they budgeted is not what they met when they enter markets. And what caused it? The price of food increase started due to the removal of subsidy. For example, look at the honor before. From Sokoto to Lagos, how much are we transport it? The bag we are carrying at the rate of 500, 1,000 before. Now we are carrying 8,000 naira per one bag, 8,500. Even some trailer drivers used to collect 9,000 naira. And all those things added to the price of the markets because the thing affected them through the diesel. We were told that the amount they are buying diesel in a pumping and a filling station is higher than what they are expecting. Majorly, what they bought yesterday is not what they are going to buy today. And those things is adding to the increasement of all things in Nigeria.
At this point, I'm now joined by Dr. Joshua Bamfo, our partner at the head of the transfer pricing services practicing at Anderson in Nigeria, and he will be unpacking this for us. Thank you so much, Dr. Bamfo, for joining us.
Thanks for having me.
So I'm sure you heard what one of the vendors there said at the market, even as we look at the issue around the hike in inflation figures in the country. Now, headline inflation rate increased to 31.70% in February from 29.90% in January. Looking at all what has been said, how would you say these issues have actually significantly impacted the numbers during this period?
Thank you. Clearly, I think whoever was interviewed was spot on. I mean, I think he might have some knowledge of economics. But if you look at what we are experiencing today, it's pretty alarming. You have to go back to sometime in January of 2023. Inflation was deemed to be very high even then. At the time, inflation rate was around 21.8%. As of February 2023, it was around 21.9%. You fast forward it to January, as you rightly said, of 2024, a year after, we saw inflation rate at 29.9%. And that was deemed to be extremely high. And that's the reason why Central Bank of Nigeria actually tried to take measures to intervene to bring it down a little bit. We saw the monetary policy rate increase significantly from 18.75 in July to 22.75. But for it to have actually increased to 31.7% in February is pretty significant. And you can actually feel the impact on individuals in the household sector as well as firms in the business sector. For individuals, that means that cost of living has gone up significantly. So for an individual that already has a job but hasn't gotten a commensurate increase in salaries, cost of living will mean that a high cost of living will mean that now they can purchase lesser of the goods and services they need compared to before. If you don't have a job, then that's even the worst case scenario. You already don't have a job, but the average prices of goods and services, especially necessities such as food, have gone up significantly. As you rightly said, when you look at food inflation, it's even higher than the headline inflation of 31.7%. Food inflation is around 37.1%. So clearly, all these add up to the misery or the suffering of the people. If you're in the business sector, it still impacts you. Your inputs, whether it's raw material, or, whatever it is, in order to produce, have gone up, which means that you will then have to find ways and means to pass on those increased input costs in the form of higher prices of your final product to final consumers. And it's not all the case that you are able to successfully do that, because if there isn't a commensurate demand for your product, then those products will not be sold in the marketplace, as we saw in the video that you showed earlier. So clearly, this has led to an adverse impact, not only to individuals, but also to businesses, and this is of grave concern to the economy as a whole.
Just as you've mentioned, the MPC increased the benchmark interest rate by 400 basis points to 22.75%, and that's part of what is needed to actually rein in inflation, according to the Apex Bank. But then, when are we supposed to start seeing its impact on inflation numbers?
So clearly, the increase by 400 basis points was significant. I mean, it came as a surprise to some. For some economists, it wasn't too much of a surprise, but that was very significant. However, the potential impact can be analyzed from two perspectives. First and foremost, an increase in monetary policy rate is supposed to be a signaling effect for other interest rates in the market to also increase likewise. And that's the reason why it's a benchmark rate. So with the increase in other interest rates in the marketplace, what is then going to happen is that cost of borrowing is more expensive. So you have individuals and businesses, be more reluctant, to be a little bit more reluctant to borrow from the banks and to spend. All right. So what it tries to do is then to curb demand and therefore help stabilize average prices of goods and services. However, you bear with me that the transmission mechanism in a country like Nigeria, where it's a cash economy as opposed to a credit economy compared to the likes of the US, will not have the same impact, because even if you increase the cost of borrowing and people spend based on cash that they have, then that impact will not be as impactful as compared to economies where people spend more based on credit or loans from banks. So that is one reason why we've not seen an immediate effect. The other reason, which is more important, is for us to understand the sources of inflation in the nation today. There are about four major reasons why we have high inflation today. And three of them mainly are from the supply side as opposed to the demand side. So the first factor you can think about is, food insecurity. And because of food insecurity, we have the prices of agricultural products going up. So this is a supply issue, a shortage of supply of agricultural products. The second has to do with the removal of fuel subsidy, which has increased the cost of transportation of some of these products from the hinterlands to the urban areas. This is also a supply side issue, which has actually increased the input cost or the supply cost of supplying these particular products. The third element that you can think about has to do with the volatility of the exchange rate. The exchange rate has depreciated significantly compared to from June 2023 to today. With that high level of depreciation, what is going to happen is that for importation of inputs or importation of finished products to sell onto consumers, these are going to cost us more. So this is another supply side issue. So if you then increase interest rate, which is supposed to curb demand for goods and services, but you've not addressed any of these supply side issues, no matter how you increase the MPR, you're not going to have that desired effect in the short term. So we've always recommended a combination of monetary policy, which is being managed by the Central Bank of Nigeria, and fiscal policy, which is managed by the Ministry of Finance as representative of the federal government, in order to curb this. If not, we are not going to get immediate results. Yes, the increase in MPR has signaled the fact that CBN actually sees the management of inflation rate as a very paramount issue. However, because the increase in monetary policy rate cannot solve the whole problem, we are not going to see immediate results in the short term. But over time, if we're able to enact other fiscal policies, that would actually help the monetary policy become more effective. There we can see inflation stabilize and over time start going down to the target that they hope to have by the end of the year, which is around 21%.
Okay, yeah, you've actually mentioned a couple of things that needs to be done in terms of policies to be implemented, but then we see that as far as the Nigerian government has gone, we've not really seen any drastic change. You said it's going to take time, but let's see how it affects other areas now. We know that notable price rises we're actually seeing in passenger road transport, housing rentals, both actual and imputed, medical services, pharmaceutical products, and all that, and people having to pay more for these services. So when we look at what the government has done so far, is it a time that we start seeing actions geared towards addressing these issues drastically? Because some people have said that these measures do not directly or frontally correct these anomalies in the economy. So what do you think should obtain in a saner climate?
So I fully agree with you. I think the government should be more direct and intentional in addressing some of these issues. So as I said, food inflation is on the rise. It's around 37%. So clearly the insecurity issue has to be addressed, and that cannot be addressed by the CBN. It has to be addressed by the government. So government has to pay particular attention to addressing these insecurity issues so that the regions that actually produce these products can actually produce at its optimal level and be able to then transport it to other parts of the nation for consumption. So clearly, there should be emphasis on dealing with the insecurity issues in the regions where food production actually occurred. The second element has to do with the fuel subsidy removal. The question is, yes, on paper, it's a technically sound policy, but the timing of its implementation, how it was implemented, has to be looked into. A lot of economists advocated for a phased approach where you don't do a total removal from day one, because inflation rate was already on the high side as at the time that the new administration took over and implemented this policy far back in June 2023. I think we really need to relook it and see whether some management of that fuel subsidy can be done so that the petroleum product cost doesn't adversely affect the transportation of these food products from the hinterlands to the urban areas. So that should be some direct intervention that the government can actually deal with. The other bit, which now goes to CBN because it's a monetary policy issue, has to do with exchange rate. We know that the CBN has actually moved from a fixed exchange rate regime to a more floating exchange rate regime, allowing for market forces to determine the price of foreign hard currencies. However, there might be the need for some intervention because studies have shown that the naira as of today seems to be undervalued, which means that if we were to intervene and set the price a bit lower towards 1,000 naira to $1, that should actually set some level of what the equilibrium price should be. So I think it's about time we need to reconsider whether the government shouldn't have some responsible intervention in terms of setting of prices within the foreign exchange market. We've had studies from institutions such as Goldman Sachs that believe that even without government directly intervening, we hope that the exchange rate would drop below 1,200 naira by the end of the year. But that is assuming all factors remain constant, and we really cannot predict. So I think government has to be a bit more open-minded to potential responsible intervention to actually bring the price of foreign currencies down, because if not, this inflation rate is going to persist. The last bit has to do with the adverse impact of the ways and means advances that the previous administration got, which actually led to excess supply of money into the system. The Central Bank of Nigeria is actually doing a decent job of mopping up excess liquidity, and that's the reason why the monetary policy rate was increased from 18.75 to 22.75. The cash reserve ratio has also increased from 30% to about 45%, which will limit the bank's ability to give out loans. And there's also been some open market operations to make sure that they've mopped up excess liquidity in the banking system. So by and large, I think these are some of policies that needs to be implemented, both from the fiscal policy side as well as monetary policy side, for us to get some desired results. And hopefully government will take up the challenge and address these short-term measures as quickly as possible. We know that there's going to be some long-term measures that needs to still be implemented. Infrastructure development, restructuring of the economy to be more export-oriented and import substituting. But those are more medium to long-term. But these are some short-term measures that can be implemented in order to curb inflation and make people's cost of living much better than we are facing today.
Okay, let's still stay with the issue around Forex just about a few seconds. Now, between June 2023, when the foreign exchange market was liberalized, and mid-February 2024, the Naira depreciated by 69%. We all know that. Now, while this has led to a considerable rise in import costs, has it encouraged exports in any way? And where do we put it? Is it part of a short-term goal or a long-term goal? Because we know that as at the inception of the floating of the foreign exchange regime, this was part of the things that the government and the CBN said we would begin to see.
All right, so clearly, I think the objective of the CBN when they decided to move away from a more fixed exchange rate regime to a more free floating exchange regime was to deal with some of the adverse, consequences of having a fixed exchange rate regime. Because what we saw under the previous administration was a huge variance between the official rate and the power market, leading to some rent-seeking behavior such as round tripping, which led to a less appropriate allocation of resources. So clearly, by moving to a more floating exchange rate regime, what you are doing is that allowing market forces, that is demand and supply of Forex, to then determine what the price should be, which is the exchange rate. But that said, even though they've been able to achieve some level of convergence between the official rate and the power market rate, what we've seen is that it has come at a huge cost due to the significant depreciation of the Naira from June 2023 to today. Prior to the current administration, the official rate was around 450 Naira to a dollar. Power market would have been around 700 Naira to a dollar. Today, both are hovering around 1,600 Naira to a dollar. And that has come with adverse impacts such as high inflation. I think what is going to be important is that, first and foremost, a weak Naira doesn't really benefit us as an export and our exports, because most of our exports are raw materials and we are just price takers. We don't determine the price. Big players in the international market, such as China, such as Japan, have an incentive to have a weak currency because they are export oriented and they tend to control significant portions of that international market. So by depreciating their currency, what then happens is that it makes their exports cheaper and there's a commensurate increase in demand for their products. All right. But that is not in our case. What we need to be doing is to ensure that, yes, we want to export more as a country, but we want to export products that with added value so that we can command better pricing. We want to ensure that we have backward integration, to have some import substitution so that we don't import as much as, in excess, all right, which can then affect our demand for Forex. So by and large, I don't think that there's been, some positive impact on exports just because we've had a fast depreciating Naira. However, in order to address this volatility of the exchange rate, it's important that we restructure our economy to be more export-oriented. And even in terms of the export orientation, we move away from overdependence of export of raw materials to exports that are value-added, all right, which then we can actually be able to control the pricing a little bit. And that can help deal with the exchange rate issues while doing some import substitution and policies to ensure that we don't over-import, which then puts a lot of pressure on our Forex. So in my view, there hasn't been any strong positive impact on exports just because we've had a depreciation in the Naira.
Well, with all this being said and different efforts being put in place by the CBN, of course, they are hoping, or the Apex Bank is actually hoping that inflationary pressure would actually decline in 2024. And that is what a whole lot of people, most especially Nigerians, are hoping for. Even the marketers, all the marketers have come out to say that if the Port Harcourt refinery picks up in the next 2 weeks, that would also reduce the price of petrol. That would also, in a way, reduce inflationary pressure on the economy. Thank you so much, Dr. Josh Bamford, partner and head of the Transfer Pricing Services Practice, Anderson in Nigeria. It was nice talking to you.
Thanks for having me.
And I'll go on a short break on Business Edge. When we return, we'll look at other areas. Bringing you into international business stories, the artificial intelligence boom has hit the crypto market with a bang. Coins linked to AI-focused crypto projects have jumped alongside tech stocks like Nvidia, driven by insatiable investor appetite for applications like machine learning. The rise of many AI crypto tokens has outpaced even that of Bitcoin over the past year, as the world's biggest cryptocurrency has surged to record levels. Their combined market value was ballooned to $26.4 billion from just $2.7 billion last April, according to CoinGecko data. Tokens linked to these projects are up between 145% and 297% in the past 30 days. Shares were mixed in Asia on Tuesday after the Bank of Japan hiked its benchmark interest rate for the first time in 17 years, ending a long-standing negative rate policy at odds with the stances of most central banks. In a widely anticipated move, the BOJ raised its overnight call rate to a range of 0 to 0.1%, up from minus 0.1%. It said that wage increases and other indicators suggested that inflation had stabilized above the BOJ's 2% target, but noted extremely high uncertainties, including weakness in industrial production, exports, housing investment, and government spending. Market reaction was, however, muted. Finally, oil held the bulk of a gain with the impact of Ukrainian drone attacks on Russian refineries and OPEC Plus supply cuts in focus. Brent steadied below $87 a barrel after posting the highest close since the late October. On Monday, West Texas Intermediate was above $82. About 600,000 barrels of Russia's daily refining capacity has been knocked out, according to Gunvor Group Limited, while JP Morgan Chase and Company flagged 900,000 barrels. Crude is on course for a third monthly climb after breaking free from a narrow range it had been trading in for much of the year. OPEC Plus supply curbs have helped to bolster prices, and Iraq said this week it would cut oil exports in the coming months to compensate for not having delivered in full on its earlier pledges to reduce production. And that's it. In our next conversation, we'll be looking at two areas: Nigeria's functional oil drilling rigs that's said to have increased to about 16, and we'll look at Angola, even as we see China saying it is willing to work with the top oil producer, even as the country moves away from oil. Let's look into it in a bit. Now, the Chief Executive Officer of the Nigerian Upstream Petroleum Regulatory Commission, Gbenga Komolafe, has recently highlighted successes in Nigeria's oil sector, citing 51 approved field development plans expected to attract about $17.64 billion investment and yield 2.12 billion barrels of oil, including 13.13 trillion cubic feet of gas over 5 years. Also, $2.5 billion investment in 175 well drillings and $2.68 billion in 842 well workovers are also anticipated. Now, despite current oil production averaging 1.33 billion barrels per day, technical potential stands at 2.26 million barrels per day, offering investment opportunities. From London, UK, Sean Dania joins me. He's an energy consultant, and he will be shedding more light on this. Thank you so much for joining us.
Good morning. It's a pleasure to be here.
So we see a projection of about $17.64 billion of investments, a yield of about 2.12 billion barrels of oil. We're looking at 13.13 trillion cubic feet of gas in 5 years and $2.5 billion investment in well drillings. These numbers, very interesting, I must say. And to some other people, they will say this is pretty good if we can actually hit the heights. But then, is this visible, considering the certain constraints that the Nigeria oil and gas industry is faced with?
Oh, definitely is visible. Very feasible. The thing is, of course, we have the underlying challenges, which are insecurity. And I believe that the current administration has been doing quite a lot about that. We also need to ensure that our currency is stable, and then we also need to ensure that we gather, we put in the right infrastructure to ensure that people's investments do not go in flame. But if we are going by the reserves that we have under the ground, yes, very feasible if we put in all the work in place.
But then if we look at the issue around insecurity, pipeline vandalism, we see that a lot have been expended by the Nigerian government to dealing with these particular menace, but then the gains have not been commendable, appreciable, as the case may be. We talk about infrastructural development also. Quite a number of challenges in that particular area, a lot of bottlenecks when it comes to having that come into effect. Now, looking at these challenges, what do you think the problems are that the Nigerian government will need to tackle headlong if we are hoping to see a close in the gap when we talk about oil production and the benefits that should come with it?
The solutions are in the already passed Petroleum Industry Act, where it talks about how they manage or how they properly manage, host communities, whereby a lot of the ownership of the assets belong to the communities. They establish sort of like a trust whereby, the communities see the reinvestment of, the oil and gas assets. And that way they would also take ownership of ensuring that they secure the assets around them. These things are more, of course, will be things that I believe that will get, the security levels to a lower, because what it is always reward versus repercussion. So if you have people who are already making so much money from vandalizing pipelines and creating chaos within the places, you have to also, then what are the repercussions? Are there any of them getting caught? Are any of them getting arrested? Are any of them getting jailed? And then of course, for the people who are within the communities, the thing is, if they see rewards in joining, these militant groups who end up vandalizing properties and everything, versus, them being actually benefiting from the oil assets that we have. So I think, pretty much on the fundamental level, community management is one of the, host community management is one of the, and it's all covered within the PIA. So implementing, the actual things that we have in the Petroleum Industry Act, which of course the NUPRC and the government have actually committed to, we'll begin to see results very, very soon.
All right, so when it comes to prioritizing investment opportunities for both domestic and international investors in Nigeria's oil sector, what do you think the criteria is and how much of that has been met?
Criteria, a lot of people want to see secure environments. A lot of people want to be able to, secondly, even for international investors, when they invest in the country, they want to be able to get their proceeds out. So Nigeria needs to be very, very, very enabling environment. Right now, if you ask me, my belief is that we're a developing nation and we should, kind of like channel our energies towards solutions that work for developing nations, So if we have to put in things that may not be normal, but would attract investments, because capital is difficult to get. And when people want to invest, everybody's looking for stability. So for people to want to come into Nigeria to actually put in so much money, the government needs to also, and they've always had incentives, like pioneer status, tax breaks and whatnot. But I think they probably need to, look at that further. We know the country needs money. However, for businessmen, they always have to, balance their risk and see the opportunities. Right now, Nigeria, of course, with the fall of the Naira, it's been difficult for international organizations to get their money out. So these are the things that a lot of people look out for. So Nigeria, the government needs to work on reestablishing investor confidence within the markets, and definitely we'll see the boom. It's without a doubt that Nigeria is the biggest market in Africa, and even so other parts of the world, in terms of oil products and whatnot, and people are willing to invest in Nigeria. However, those fundamental issues need to be properly attained, and then investors will come rushing. They are already at our doors. They've been here, some are pulled out, but everybody's watching. That's why I see during every election, you see a lot of Nigeria, you have a lot of international papers, always, monitoring, national observers monitoring Nigerian elections, because they want to report to people outside the world, all over the world, the status of Nigeria, if it's stable, what the new administration, entails. And that way, investors are able to make informed decisions.
Okay, let's tie that around the Petroleum Industry Act you mentioned earlier and the issue around the licensing rounds. Now, what is the regulatory framework like and how robust is it in ensuring transparency and fairness?
So, as it's where we've seen results, right? So the NUPRC, they're committed to transparency. The industry the PIA, requires fair, transparent, and competitive bidding process, and we can see that from the NUPRC. They already, right now, they've published licensing round guidelines, and they've also published, the plans to develop 7 deep water blocks. This is not, it's not the first, but I mean, it's very, 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 it's applaudable, for us to be seeing this kind of thing. So it ensures that, the guidelines are properly clear, the bidding terms, the opening them to qualify domestic and international companies, all of those information are clearly out there for the public. And, it seems that they're using a very transparent evaluation process. And even though people have criticized and raised concerns about the past licensing rounds, I think it's very important that we monitor this new licensing round that is about to commence, and we then can able to score the leadership of the NUPRC.
Okay, so at this point, we now look at Angola, because that's another major oil-producing country on the continent. Even as Nigeria is struggling to get the numbers, we see another African country that is trying to diversify its economy. And the Chinese president, Xi Jinping, has come out to pledge his support for Chinese firms in Angola, even as we know that the country is hoping to look at how it can improve the manufacturing industry and the agricultural industry. So we'll quickly look at that. Sean. So one question a lot of people are asking right now is that why in the first place is the Chinese government willing to help Angola diversify its economy? Is it to the benefits of the Chinese government, or it will speak more in improving Angola's economy?
I mean, it's without a doubt that Angola owes the Chinese a significant amount of money. I think running well over $12 billion, So, of course, it's in the best interest of the Chinese to help Angola to diversify away from oil, and definitely China is looking to secure a more stable and reliable borrower in the long term, and a broader Angolan economy would definitely create new markets for Chinese goods and services. And yes, of course, in the long run, it's now up to the Angolans to ensure that all of these monies that they're being borrowed, all the goods and services, all the expertise they actually use to develop their own country and, reduce their dependence and reliance on the Chinese. So, I mean, pretty much everybody has their own interest when it comes to trade. So the Chinese have their interest, the Angolans should also have theirs.
So then why is Angola even planning to move away from a major money spinner? We know that what it gets monthly and yearly is in the tune of millions and millions of dollars. At a point, it was even topping the chart when it comes to oil production on the African continent. But then it's looking at other areas whereby it can generate more revenue. Why is that?
Can you hear me? I mean, Angola has huge potential in agriculture. I think they have huge deposits of, the agricultural resources. They can grow a lot of sugarcane, coffee, cotton. They also have reserves of base metals, even though these have not received any level of investment since oil. And we know that the world we are in now, we're talking about climate change, we're talking about global warming, and people are going towards cleaner, more renewable energy. So not moving away completely, but diversifying the economy is actually the way to go. Developing all these sectors would also create jobs, reduce reliance on imports, provide more stable economic foundation for the country of Angola. And sky is always the limit. Everybody in Africa moved away from most of their resources, even like Nigeria, when we all discovered oil. It's time to go back, diversify our economies, make use of agriculture and other things that will make people more reliant and more dependent on the African countries.
But then the question will always be if these other areas are sustainable, most especially when investments go into agriculture, manufacturing, or probably the mining sector. Of course, if funds can be pulled into those areas, can they sustain the economy, not only for Angola, but of course, Nigeria that you mentioned?
Definitely. So, of course, it's not abandoning one for one. It's actually diversifying, and diversifying will mean that you will explore all those avenues. So you're not leaving oil 100%. So there's oil will be there. You also use that. Let's not forget that the Western region, in Nigeria at some time was built with money from cocoa. And cocoa is still there. People are exporting cocoa on a regular basis. People are exporting even coal, even as much as little as seismic seeds from the north. I mean, we're exporting a lot of things in Nigeria in terms of agriculture, but are we getting the benefits directly? No, we are not. And definitely, it can sustain us as a nation. There are a lot of nations that, we have palm oil in excess here in Nigeria. Agriculture definitely can sustain the nation.
Okay, finally, Sean, before I just let you go, I just want to chip this in. We see that Nigeria and some other African countries that export crude oil, exporting these commodities in their crude form. Now we hear that if the Port Harcourt refinery is brought back on life and starts operating, Nigeria will be able to reduce the amount they pay to buy petrol, as it were. Now, two areas. Number one, is there something that can be done in regards expanding the value chain whereby Nigeria can have these commodities processed and exported in its finished form? Two, and will that also translate into a reduction in the inflation figures?
Well, two things. Yes, it will reduce the prices, but of course, the only way that will happen is if Nigeria prices its own refined products in Naira, because what it is everybody benchmarks the price of oil with, international oil prices. So crude oil that is actually refined, even though, there are some dollar components in the drilling operations, but a large part of the operational costs, is also in Naira. So if we have our refined products priced in Naira, definitely Nigerians will see the impacts. They will feel the impacts 100%. The prices will be lower because then we are using our local currency to buy our products, so we can actually use our own local figures and statistics to benchmark our prices.
All right, Ashil Dania, energy consultant, thank you so much for your time.
Thank you very much for having me. It's a pleasure.
Of course. Now, that's it on Business Edge for today. Don't forget to visit our social media handles at News Central TV. That's it. Now, you can visit our website, www.newscentral.africa. Adequately download our mobile app on App Store and Play Store. I am Lekon Obanjo. Until next time, enjoy your day.